choosing the wrong one can literally cost the business owner thousands every year. And
one of the biggest tax mistakes like a business owner make is with their car. Either they barely deduct anything or they deduct the entire expenses of the car. That's how they are creating an audit issue for themselves.
Hello there, Salim Omar here from Straight Talk CPAs. Today I'm joined by our senior tax advisor, Sabir. Sabir, welcome.
Thank you, Salim.
Today, we're going to talk about a topic that we get a lot of questions on, don't we? And we're going to go in detail of what the two methods are, the actual versus the mileage.
Yeah. So as you said, there are a lot of questions and a lot of ambiguity when it comes to deducting your vehicle. So one of the biggest tax mistakes like a business owner make is with their car. Either they barely deduct anything or they deduct the entire expenses of the car. That's how they are creating an audit issue for themselves. Now the problem is most people doesn't understand then that there are two completely different ways to deduct a vehicle.
So choosing the wrong one can literally cost the business owner thousands every year. And we're going to show you that where the mistakes happen, what to watch out for. And that's what this episode is going to cover today.
Exactly. So, like a lot of people assume they own the business and they own the car, so they can deduct everything related to that car, right? But the IRS doesn't allow that. You have to choose one of the two methods. So, those methods are like a standard method. So, we also call it a mileage method, and another one is an actual expense method. So, those are totally two different methods. If I explain those methods in detail, the first option you have is the standard mileage method. IRS has predefined what is the dollar amount you will get for each business miles, right? So for 2025, it was a 70 cent, and for 2026, it is a 72.5 cents. So basically, in standard mileage method, you don't have to do anything, like not much of a thing. It is not an headache for most of the taxpayer because you just have to track your business miles and multiply those business miles, that mileage cents given by the IRS. So that is 72.5. So let's assume you have a 10,000 miles and 72.5, when you multiply it, it would be around $7,250. So you get the deduction in that. Now, that $7,000 includes everything. Like it includes your gas, maintenance, insurance, wear and tear, everything. So you can't go like taking the mileage deduction and also adding all those expenses in your income statement. It is, like a very thin line between those. So need to be more careful when we do that.
So you mentioned two methods, right? The standard mileage and then the actual. Then you just kind of quickly shared with us what the standard mileage is. It seems like the easier one to use for a business owner or even low stress option. Is that correct?
Yes. So I mean, no, it's like when they are not sacrificing much on the actual expense method side. So just to have a less headache, they can just go with the standard mileage method.
Got it. Talk to us about the second method, the second option, the actual expense method.
So the actual expense method is where your deduction can get big, because under that method you get a deduction of all the actual expenses which you are doing for your car. So that includes gas, repairs, insurance, registrations, and depreciation. So that's the biggest big ticket item for the actual expense. Sum up all those actual expenses and then you apply your business percentage use there. So that's like again business miles divided by total miles. So if that comes to 80%, you apply that 80% on all the actual expense. This method usually make more sense for expensive vehicles, lower mileage or SUVs and trucks, where depreciation can push you to the higher limit of the deduction.
The actually is better for expensive vehicles, and so a $60,000 vehicle, then you've got the depreciation component of that is going to be higher. So utilize it. That makes a lot of sense. Maybe give us a couple of examples or at least one example that we could to really bring this home for us.
So let's assume you bought a vehicle for $60,000 and your business use percentage is 80%, right? So if you talk about the mileage method, you will technically get somewhere around $8,000 to $10,000 of deduction. So we are assuming your business miles would be around 10,000 miles. So when you multiply that 10,000 with 72.5 cents, you technically get the deduction somewhere around $7,000 to $8,000. So this is the standard mileage method. But with actual expenses, you need to depreciate that $60,000 over the period of 5 years. So 60,000 divided by 5. So I'm explaining here the simplest version of it, because there are a lot of layers in there when it comes to vehicle. There are gross vehicle weight, bonus depreciation, section 179. But all in all, when you divide the purchase price itself with a period of 5 years, so you get a 10,000 alone from that purchase price. And top of that, you can add insurance, your gas, your repair. So that pushes you over above $20,000 as against the $8,000 deduction under the standard mileage method. Just sharing the thought here. So there is another extreme as well, where standard mileage make more sense than actual. Even though you are getting a bonus depreciation on actual, standard is more beneficial. So I'll explain that at the end of the video. So
really, what this means is you've got to run the numbers. We cannot just say standard's the way to go, or we cannot say actual's the way to go. It really, really varies situation to situation, doesn't it?
Yes, definitely. So, so to add another layer of complexity here, the most important thing for business owners would be first year of placing that vehicle in service, right? Let's say they bought a vehicle in 2026 and they are using actual method for that vehicle. So for future years, they won't be able to use standard mileage method. So in first year, if you use actual, you do not have any other option. Keep using actual, and after the period of 5 years, you would be zeroing out your depreciation, because the vehicle has a recovery period of 5 years, right? So after 5 years, your deduction would drastically lower. So instead of that,
Correct.
if you use the standard mileage in the first year, then you can use actual mileage in the upcoming years, right? So generally, IRS is just trying to ensure that you are not double dipping here by taking actual in the first year, utilizing entire purchase price as a bonus, and then from the next year you can keep using standard miles rate for like for all the future years. So they are just trying to avoid that double dipping for you.
So remember, first year is critical. If you start with
Yes.
actual, then you've got to stay actual. But if you start the first year on standard, then you've got the option of switching to actual any year after the first year.
Yes.
Sabir, you've worked, with a lot of clients, talked to a lot of business owners at Straight Talk. What are some common mistakes that you see when it comes to this part of the IRS law?
Mistakes are the taxpayer doesn't maintain the mileage log. So that is the first one. And they end up claiming 100% business use, right? Because this is a car, and same as your mobile phone, there is some portion of a personal usage. So we can't just claim this was 100% business use. There is still some portion of that. So we always need to back that portion by maintaining the mileage log. So the biggest mistakes are not maintaining the mileage log, taking 100% business use, and not maintaining the log for the personal ones as well.
That's a kind of a way to turn a good deduction, unfortunately, into a problem if that's not maintained, and it's not realistic. I mean, if you're using a car and you're taking it home, and yeah, sure, you're using it primarily for business, but there is some personal use, weekends, grocery shop, right? So folks keep that in mind.
So just let me explain the other extreme, which I just discussed in the video, that we'll explain that in the end. There is no better method. It totally depends case to case. Let's say if you are into the business where you expect that you will have a lot of business miles, right? So let's assume your business miles are around 150K over the period of the useful life of that car. So if you are keeping that car for 10 years and you expect that within the year of that 10 years you will be using that car for 150K, right? So if you
And that's
multiply that,
reasonable.
yeah,
15,000 miles a year times 10
yeah,
years,
definitely.
150,000 is not out of the realm.
Yeah. So if you multiply that 150K miles with 72.5 cents, so your total deduction would be around 100K for that car, for using that car, right? So this is the standard mileage rate. Now if you have bought that car for $30,000 or $35,000, you will only be able to use the depreciation for the $30,000. And even if we factor in other expenses like insurance, repairs, or everything for the period of 5 years, let's add another 30,000. So that would be a $60,000 of deduction under actual method. But under standard method, you will almost get 100K deduction. So again, in these extreme, standard mileage method is more useful than actual. So it depends on a case to case basis, because like the wrong choice can cost you a real money year after year. So that's why it is important to analyze in the first year itself when you use the car for the business.
That's another extreme, isn't it? In a real one where 150,000 miles, and I just did the math on my calculator, it's $108,000 deduction over the lifetime of the vehicle, and so people can miss out on that, thinking, oh, I'm getting a $30,000 deduction, purchase price, plus, of course, my gas and all that. But maybe that's going to come to like 60,000 or 70,000 or 80,000, comparing it to this almost $109,000 deduction if you do the standard mileage. So this was an example where standard mileage can be beneficial. Earlier, you talked about an example where the actual was the better way to go with expensive vehicles or business, or vehicles that are going to have low miles on it. So yeah, point taken that there is no universal better method. It really depends on several scenarios.
Yeah, there are a lot of variables. So we haven't even talked about selling off the car, recapturing the depreciation on that sell, capital gain. So a lot of variable. It's always beneficial to just view your option in the beginning itself.
Do the analysis and run through the numbers. Very relevant. I'm glad we chose this topic because, I mean, every business owner has a business car, and this is one area out of many that we find, business owners losing out on because they didn't go about it the right way. Thanks, Sabir, for being here, sharing your insights. Folks, I hope you found this episode helpful. Please like and subscribe to our channel. Thank you.